Have you ever wondered why rising markets are called a bull market and falling markets are called a bear market? It's one of the most common terms in the world of investing, yet very few people know the fascinating story behind these names. The origin goes back hundreds of years and is connected to both animal behavior and one of history's biggest financial tricks. Let's start with the bear. Long before modern stock markets existed, there was a popular saying in Europe, "Don't sell the bear's skin before you've caught the bear." It was a warning against selling something you didn't actually own. However, in the 1700s, some traders did exactly that. They agreed to sell bear skins at a fixed price before they had even hunted the bears. Their plan was simple. They expected the price of bear skins to fall before delivery, allowing them to buy the skins later at a cheaper price and keep the difference as profit. This strategy is surprisingly similar to what we now call short selling in the stock market. Short sellers profit when prices go down. Because of this connection, traders who expected prices to fall eventually became known as bears, and a falling market became a bear market. Now, what about the bull? Unlike the bear, the bull got its name from the way it attacks. When a bull charges, it thrusts its horns upward, lifting its opponent into the air. This upward motion became a perfect symbol for rising stock prices. Investors who believed prices would continue climbing were called bulls, and when the overall market moved strongly upward, it became known as a bull market. The bear attacks downward with its paws, while the bull attacks upward with its horns. These opposite movements created a simple visual representation that traders could easily remember, and the names have remained in use for centuries. The terms became especially popular in London during the 17th and 18th centuries when stock trading was expanding rapidly. Later, they spread to financial markets around the world, including the United States, where they became standard Wall Street terminology. Today, these words describe much more than daily price movements. A bull market is generally defined as a period when prices rise by around 20% or more from recent lows, driven by optimism, strong economic growth, and investor confidence. During a bull market, people are eager to invest because they believe prices will continue moving higher. A bear market, on the other hand, is typically defined as a decline of 20% or more from recent highs. It is often accompanied by fear, uncertainty, economic weakness, and widespread selling as investors become pessimistic about the future. Interestingly, bull and bear markets are not limited to stocks. The same terms are used in cryptocurrency, commodities, real estate, and many other financial markets. Whether it's Bitcoin, gold, or major stock indices, the language remains the same. There's also a psychological side to these names. Bulls represent confidence, hope, and growth, while bears symbolize caution, fear, and defense. This is why you'll often hear financial experts describe investors as either bullish or bearish. A bullish investor expects prices to rise, while a bearish investor believes prices are likely to fall. Even though the exact origin of the bull's name is debated by some historians, the explanation based on the animal's upward attack is the most widely accepted. The bear's connection to early bearskin traders, however, is well documented and remains one of the most interesting stories in financial history. So, the next time you hear someone say the market is bullish or bearish, remember that these terms are much more than financial jargon. They carry centuries of history, reflect the behavior of two powerful animals, and represent the emotions that have always driven markets: optimism and fear. Understanding these simple terms is the first step towards understanding how financial markets really work.